Hi guys, this is SJ speaking, and in today's video, let's see about reverse repo rate. So in my previous video, I have explained about repo rate. So this is the reverse repo rate. So let's go into the video. So before going into the video, I am personally teaching trading. So if you want to join my mentorship course, you can contact me from the number in the scrolling below. I am taking 7 separate courses which consist of technical analysis, master strategy, which includes price actions. So technical analysis consists of price action as well as another master strategy, and then comes the fundamental analysis. You can enroll in any one of the 7 courses if you are interested. So now let's go to the video. So what is reverse repo rate? So first let's know about the reverse repo. So reverse repo or reverse repurchase agreement. So repo means repurchase agreements. So it takes place between banks and the central banks. So commercial banks and the central banks. So it is a type of loan, especially short term, but it can also be long term, which is taken by the central banks from the commercial banks. So reverse repo rate is the interest rate given to the commercial banks by the central banks for borrowing money from them. So the commercial banks does not give simply the money to the central banks. It asks the central banks to submit some kind of collateral for borrowing money from them. So both the repo and reverse repo rates are determined only by the central banks on the monetary policy meet. So here on the repo rate, so the repo rate is determined by the central banks. For example, in India, the Reserve Bank of India determines the repo rate. Since they are giving money to the commercial banks, they are determining the interest rate. But in case of reverse repo rate, only the commercial banks give the amount to the central banks. So you might wonder, only the banks must state the reverse repo rate. No, it's not the case. So the RBI itself, that is the central banks, only determine this rate too. So usually, since they are borrowing the money and they are also determining this rate, usually the reverse repo rate will be lower than that of the repo rate. So the RBI acts as a banker to the commercial banks. So since it borrows money from the commercial banks and it also determines the reverse repo rate, it usually states the interest rate lower than that of the repo rate, since the central banks, they only pay the amount interest rate to the commercial banks. So this is the difference. So usually reverse repo rate is always lower than the repo rate. So how this takes place, I will explain. So both these repo rates and reverse repo rates are used to control the money supply in an economy. So before that, let me explain how this reverse repurchase agreement takes place. So there is RBI, and take for example one of the commercial banks, SBI. So here the SBI gives money to the RBI. So SBI gives around 10,000. So RBI borrows money from the SBI and instead it gives some collateral. For example, any government securities or bonds, something that the RBI has bought from the government, it gives as securities, and effectively it's actually selling the collateral itself to the RBI on the agreement that it will be repurchased. That is why it is known as repurchase agreement. In this case, it is known as reverse repurchase agreement. So these are sold to the RBI, and suppose if the RBI, the central bank, if it defaults, mostly these kind of central banks, they don't default, so the amount is safe and secure with them. But suppose in this case, suppose if the RBI defaults, what the SBI will do, it will sell this collateral somewhere else and gets the money. But there is also collateral risk. So that is why these type of loans are usually short term. So for short term means there is no collateral risk, but for long term these collaterals might increase or decrease in value, and there is risk for the person who is lending the money. In this case, it is SBI. For example, in the repo process, so RBI has the collateral risk. So that is the case. So this is the process that takes place, and now the current reverse repo rate is 3.35. So if the SBI gives 10,000, then the RBI, if it pays back the amount, it has to pay around this amount. So you can calculate according to the amount. So if you are calculating for 1 lakh, you can accordingly calculate the amount. So RBI pays back a little bit more and then buys back the securities that's submitted to the the SBI. So this is what takes place. How this is used to control the money supply, the inflation and deflation. Suppose if there is inflation, the prices of goods and service are at peak. So what happens is that the RBI usually if there is inflation or deflation, in order to increase or decrease the money supply, only the repo rates are increased and decreased. But the reverse repo rate is also changed if there is excess of inflation or deflation. So if there is excess hyperinflations like that, the reverse repo rate is also increased in addition to the repo rate. So in order to decrease, if there is inflation, the RBI must reduce the money supply. So money supply must be reduced. In order to reduce the money supply, the reverse repo rate is increased. If the reverse repo rate is increased, what the banks will do, the banks usually lend money and make profit from them. So instead of lending people money to the people, the RBI would lend its money to the RBI. So since the interest rate given by the RBI is high, the banks, commercial banks like SBI and other banks, they park their funds in the RBI and get the interest from them. So although there are two options, either the bank can lend money to the public and the companies, or it can lend money to the central bank. So when you are lending money to the central bank, it is more safe and secure when lending to the normal people, because there is high credit risk when you are lending money to the normal people or any other corporate companies. But in case of RBI, it is more safe and secure. So since the RBI is giving high interest rate, usually the banks would park their funds inside the central banks. So there is no outside money supply. So there is no lending outside. So the growth of the companies decreases since they are not borrowing money from them. And since the company's growth decrease, the salaries of the employees might not increase. And so the normal people, the consumer spending becomes less, and the demand for the products and service decreases. And since the demand for the product decreases, automatically the prices of goods and service decrease. So the inflation is controlled. And suppose if there is deflation, the prices of goods and service decreases. So deflation also affects the economy in a bad way. So in order to boost the money supply, in order to increase the money supply, the reverse repo rate, the RBI decreases the reverse repo rate. So what the bank does, it takes away the money from the RBI. Since the RBI is not paying that much interest, the commercial banks take the money away from them, and it starts lending to the outside normal people. So even some small scale businesses or those who are doing less basic work such as agriculture or some other subprime loans, they might give to the people, and the companies also get money, and the company's growth started to increase. And as the growth starts to increase, the company starts paying more salaries to the employees, and the consumer spending starts to increase, and the money supply starts to increase, and the economy starts to grow. So this is what takes place. So in order to increase the money supply, the reverse repo rate is decreased. In order to decrease the money supply, the reverse repo rate is increased. So usually the reverse repo and the repo rate and the reverse repo rate usually increase simultaneously. So you might wonder if the repo rate increase, the reverse repo rate must decrease. It's not the case. If it increase, this also will increase. If this decrease, this also would decrease. So reverse repo rate and repo rate are mostly directly proportional to each other. So, but mostly the reverse repo rate does not change. Only the repo rate changes. Only if there is excess amount of inflation or deflation, then the RBI, the central banks of the respective countries, will change the value. So, hope you guys got clarifications about this. So these rates are determined by on the monetary policy, so which must take place at least 4 times in a year. So now the current rate is 3.35%. So hope you guys got a good clarification. If you like the video, share it with your friends and family, and subscribe to my channel and press the thumbs up button, and also press the bell icon so you get notified for all my videos, and comment on my videos if you really like the video, to be a feedback for me and motivation for me for creating more videos for you guys. And of course, if you want to open a Demat or trading account, you can open the link on the video descriptions and start by opening an account and start trading or investing online. And apart from that, if you want to join my trading course, I am taking 7 separate courses which consists of technical and fundamental analysis separately as well as together. So you can enroll in any one of the 7 courses by calling me. You can have the details. So thank you guys. I will visit you on my next video. Until then, bye bye. Take care.